So, let us begin, start, all right. Now, we are with non-traditional functions of our central bank. It is not necessarily true that countries, other countries also have this kind of a setup. And we are with kind of an end of the non-traditional functions. We were talking about other credit control methods. And the first one I took up, which I often refer to, which you may have also heard, this is called statutory liquidity ratio. Only doubt I have about is whether it is being maintained on a weekly basis or fortnightly. I think fortnightly. All right. And SLR is quite different from CRR, that you have also noticed. CRR mein khali cash hai. SLR, it has many things in it. Okay. So, I talked about that too, and the upper limit of SLR, and we did reach upper limit of SLR around 1990s, about 38.5, nearly upper limit, 40% hai, 38.5 in 1990 SLR. Oh. Having said that, now I go to something which used to be very important when we were students, not so important anymore, under other credit control methods. And this is called SCC. SCC is selective credit controls. Now, selective credit controls are available in India with the central bank, maybe there with some countries, and if you notice what they are, it's very country specific. It has to be, because selective credit controls are very much determined by the type of economy one country has. Okay. In India, what kind of economies we have? If you look at you went through my first course, huge agricultural land, agricultural sector. In terms of contribution to GDP, it is shrinking, but that does not mean that it is a minor sector. Agriculture sector huge. If you take, for instance, number of people who depend upon agriculture for livelihood, is massive. Over 60% people still depend upon agriculture in India. Okay. So, from that point of view, agriculture is very important. And you also have notorious urban or semi-urban economies where hoarding has been rampant. What is hoarding? Wholesalers often practice that. What they do is, suppose they pick an essential item like Vanaspati or some other cooking oil. They used to do that, I remember. Sugar, which used to be not abundantly available in the open market. They take that, they hoard. Hoard means create an artificial shortage in the economy. What you do by creating an artificial shortage? In terms of demand supply, you shift the supply curve backwards, so the prices go up. Once the prices go up sufficiently, they release the stocks slowly into the market and make extra profit. So, hoarding has been rampant. In modern economy, India, a different kind of underground or whatever, not underground activity, different kind of illegal activity that goes on is that, which we had cases here since 1990s. Before that, there was one case in 1960s, major case. Small cases may be there. One incident was there. There where some speculator in the stock market artificially creates a rise in price of stocks through kind of a hoarding or whatever to make extra profit. Fools the stock market. There you require a huge amount of cash. In hoarding of essential goods also you require a huge amount of cash, because you need to buy out the entire surrounding areas from wherever supply comes and hoard them. You have to plug all the supply routes to create an artificial shortage. And that requires a huge amount of capital, money capital, to buy out the goods from other producers or producers and sellers, wholesalers, and create that shortage. Or you can collude with all wholesalers or some major wholesalers together, like drug cartels or OPEC oil prices. They collude, form a cartel and act like a monopoly and raise the prices, create supply shortages in the market. Stock market hoarding also, speculative activities, similar kind of things happen, and their bank managers, etc., all get involved. Now, selective credit control, if you look at selective credit controls when Indian economy used to have selective credit controls, is that they were basically motivated by the seasonal nature of our agriculture. Early days, 60s, 70s, agriculture was more important. Now the service sector is developing, so some employment is going there. The industrial sector or the manufacturing secondary sector share may be going down, but the service sector is taking over employment generation in India primarily. I mean, the jobs you will get will probably 99% will be in the service sector. 99%. Even other engineering departments jobs are there these days, not in manufacturing just because I am a mechanical engineer or something. So, the seasonal nature of economic activities where there is a sowing season, then there is a harvest season, there is a gap. Now, during both the seasons you require fresh money to be available, liquidity to be available, credit to be available. And now, if credit is not available during harvest season, or there is credit available with very dishonest hoarders, they can choke off the fresh supply from the going into the market and create the scarcity at the harvest season, for instance, sugar, rice, wheat, whatever. So, hoarding and inflation, which has been a major problem in India, they all are connected, and therefore, Reserve Bank from time to time would issue guidelines to banks, commercial banks, regarding selective credit controls. And they are just not the agricultural commodities, they are also sometimes with respect to, as I told you, there have been notorious cases, share market speculation, where they have been hoarding and artificial rise in prices to make extra profit. All right. So, the commercial banks and to some extent cooperative banks are primarily involved with RBI in chalking out plans regarding credit supply. Now, what kind of a guidelines used to come? There used to be three kinds of, broadly speaking, selective credit control guidelines that used to become, or instructions from RBI to the commercial banks for specific time periods, like 2 months, 1 month, 15 days, whatever. What are they? The form they took in hoarding are the following. Number one, minimum margin requirements. This is one kind of a guideline that used to come. Now, it can be various margin requirements, commodity specific, it may be commodity specific, it may be sector specific, it may also be producer specific even, because some hoarders or wholesalers are very well known to the community that they hoard. So, it can be very specific company, specific to company or individuals. What is minimum margin requirement? That I need to explain. What happens at the time of sanction of loan by commercial banks to a company when it applies for a loan? Company, of course, has to submit all sorts of documents regarding its functioning, financial statement or whatever, balance sheets, profit and loss account results, last 5 years, balance sheet maybe. They also have to show some or submit some collateral securities. All right. That collateral can be of various kinds. The collateral can be simply in terms of valuables like jewelry or land or property. Collateral can take various forms. Now, once the collateral is shown, the security is shown to the bank, bank doesn't necessarily grant a loan equal in value at current market prices, equivalent in value to the collateral. It doesn't. Suppose the collateral is worth 10 crores. The bank may not sanction 10 crores. Bank will have a margin requirement. It will deduct 15, 20, 25% of that value, and then whatever remains from the collateral current market price value, they will decide how much loan to give to a particular party. So, suppose you have a property worth 1 crore and you show that property at current market prices to the bank with all your documents, legal documents, deeds, etc., and say this is my collateral, give me a loan for this purpose I need. The bank may not give you 1 crore of loan. It doesn't. There is a margin requirement. Some amount is chopped off from that current market price value of the collateral. And then whatever remains, the loan is in proportion to the remaining value of the collateral. So, the margin requirement therefore is a powerful instrument as a selective credit control method in the hands of the bank to control the amount of money it can release. For instance, in case of farmers, poor farmers during sowing season, RBI may issue a guideline, the margin requirement be cut down to nearly 0 or 5%, whatever collateral they show, because they are very poor farmers. But in case of a hoarder, it may increase the margin requirement during harvest season, which are notorious borrowers, they know, they would come and borrow legally. They may increase the collateral from 25 to 40%, 50%, the margin requirement. That means 25 to 40% means 40% of the collateral have to be deducted. Then the bank will think how much money it will give to that particular party. So, it can work both ways, to tighten dishonest borrowers from getting too much, they already accumulated wealth, so they can show collateral very easily, and to loosen and help out the poorer section of the society like farmers, where the margin requirements have become, they can make it minimum. You understand what I am saying? Okay? During harvest season, sowing season, etc., and share market investments so that they don't get. Then you want, sir, if there are selective credit controls, how did Harshad Mehta collude with the bank managers? Well, these are all ignoring these rules often, violating the norms, they do. In India, it is always possible. Now, once you are caught, you are caught. Often you are not caught. Harshad Mehta at least had 10 to 20 bank managers in their pocket. Where did he get the cash to control the Bombay stock market or whatever? Stock market price, because a huge amount of cash. How did he get it? It has to come from somewhere. It came from banks again. So, speculative activities in the share market and speculative activities in the goods market, particularly food items, have been very common, and selective credit controls in terms of this instrument used to be very common, popular in India. RBI would issue those guidelines. Second, then they can specify minimum lending rates also. When the banks are giving loans, banks during sowing season, the loans that you will give to the farmers will have less than your normal rates. So, if the normal rate is about 12%, make it 6%, maybe 7%, maybe 5%. Minimum lending rates, they can specify. That is why they used to control banks. That is why we never had a free interest rate regime in India, bank interest rates. They were all controlled. So, the next point is the lending rates, minimum lending rates. This is another instrument that they would use, and differentiated rates also. If it is for this purpose, is the minimum rate. For another case, it may be wholesaler buying goods from the producer, rates are very high. all right. Farmers borrowing for buying fertilizer, seed, etc., rates are very low. They are differentiated rates, and they would set for specific time periods, for specific sectors, for specific borrowers, groups of borrowers. RBI used to control that. Third point is the very important, this is with respect to these hoarders, black marketeers, which we also call them, black marketeers, hoarders, in food items particularly, who create artificial shortages in the market and raise prices. Third instrument under selective credit control commonly used in India, the third item, maximum advances to individual borrowers. Maximum advances to individual borrowers. They can, as I was telling you, often they have information like a police department. Which are the guys, which are the companies responsible for hoarding, right? Say in Banaspati, they know the wholesalers. That used to be the case. Sugar, they know. So, RBI would simply put a limit on the upper limit on the advances they can get, particularly during those seasons when they would hoard. In other months probably, they are very seasonal in nature. Selective credit control has been very seasonal in nature. They are not often there, the restrictions are often not there throughout the year, all 12 months. They are there for 2 months, again a gap, again for 2 months maybe, or 1 month, 3 fortnights or whatever, and then off, they would go. So, this is the 3 main routes they used to take, all right. And selective credit control rates I have told you, but then what happened, I have a data from 1971-72 or 72-73. Let me tell you about the SEC minimum rate, lending rates, what they did, particularly for these hoarders, etc. When it is 10 to 11% the general rate in 73-74, when I was in getting into college and stuff like that, I remember I used to study these things, very boring money and banking course anyway. Then the typical, it was 1 or 2 percentage point less than that. For not 1 or 2% was higher than the market rate. So, you need money from the bank then, but you know there are all sorts of avenues they will get that. In 1979-80, you won't believe me, the minimum lending rate of selective credit control became ranged between 15 to 18, when the general minimum rate was 12.5%. And then 80-81, 16.7 to 19.5, whereas the general rate in India was 13.5. So, the gap is big. 4-5% gap means on a loan that you are taking in lakhs or crores of rupees, huge amount of extra interest that you have to pay. All right, huge, massive amount of interest you have to pay. So, this is how it used to work, but unfortunately, I still remember the general lending rate was even less than the rate they asked me on my educational loan around 1980s. So, did they think that these students who go for higher studies or whatever, take loans from banks, should come under the selective credit control measures of RBI? Well, they would go and they will come back and do hoarding or illegal business? You won't believe me. The rates were very high, education loan rates. It's very interesting. Education loan those days, now it has changed probably. Used to be more expensive than the companies borrowing money from banks. India is a very funny country. I really don't understand all this, so you may understand this. I mean, very high. I paid an interest rate of about 18% or 17% on the loan that I took. Okay. Now, I come to this section which is very important. So, I will begin this section, I may not end it today because it is already 2:26. This started from the end of the last century and became important in the beginning of this century. This is credit control through a policy of the government of India initially, and then it is RBI policy, and RBI operates that. And this is where the repo market I talked about, RBI's repo market, this is the thing today which started at the end of last century and took shape, proper shape in the beginning of this century, under which RBI operates the repo market. There is one repo market in the bank, which is market repo, on which I have no data. Very interesting. Central bank does not care to collect data on the market repo. Only repo data they supply on their site, if you go, from where I access data, is the one which is under this policy. This is called, this is the, I am coming to the end of this topic nearly. Next week it will end, and then I will show you data. And most probably after break, most probably the last topic will begin. It's a very important topic, banks I will talk about. This is called, a thing that I need to talk about now is called liquidity adjustment facility. Called the famous LAF. So, when I supply data on repo market, it is the RBI's LAF data. Under LAF, this umbrella, they operate the repo market, and this has come to be known the most important short term money market and the interest rate also. This is LAF, liquidity adjustment facility. What is the basic concept? According to these banking industry or central bank, they have conceptually they consider or they deal with three kinds of liquidity. They deal with three kinds of liquidity or three types of liquidity. Three types of liquidity. The first one is known as autonomous liquidity. This is known as autonomous liquidity. Three types of liquidity they deal with, liquidity adjustment facility. It's called autonomous liquidity. What is autonomous liquidity? Autonomous liquidity, that is the liquidity that kind of gets created from the normal operations, banking operations of the central bank as a currency authority and banker to the government. All right. So, for the normal operations of the central bank, as you have learned so far of our RBI, central bank means our RBI, what are they? To give the ways and means advances to government when they need, both state governments and central government. Then they subscribe to the treasury bills and government securities. Earlier they used to have also ad hoc treasury bills, the money market section, all right. And then they also have the cash, the currency that they issue from time to time. Say the exporter has come, submits the foreign dollar, foreign exchange, gets it converted into rupee. The issue department and the banking department I was talking about. So, these are the normal operations of the economy, and the balance sheet of RBI would tell you that these are the money that RBI creates, or liquidity. Liquidity is essentially the cash that it injects into the system. This is as a currency authority and banker to the government, and often also probably as a banker to the banks, because banks often submit the bills they hold and rediscount them with the central bank and get the cash in return. All right. This is autonomous liquidity. Then you have the other kind of liquidity that the Central Bank of India, that is RBI, manages, is called the discretionary liquidity. Discretionary liquidity. This is not normal. Discretionary liquidity is something which RBI creates or deals with because of monetary policy it adopts. So, suppose it opts for, there is too much of liquidity, it has to sell repo, that is discretionary management of liquidity or management of discretionary liquidity. Now, I consciously announce auction of repo or whatever, reverse repo, to counter this excessive or deficient liquidity situation in the monetary sector, like repo cells. All right. This is discretionary liquidity. And it can also be just not repo cells, it can also be open market operations with government dated securities. RBI decides, like they have recently they did, they would go for open market sale of securities so that the liquidity is squeezed out of the system. Or now it is going for an expansionary monetary policy. What does it mean, expansionary monetary policy? In macroeconomics, it is known as LM shift. How does it happen? Well, one way it can happen is by open market purchase of securities, where a cash is injected into the system. LM curve will shift to the right. Open market operations. These are conscious effort from time to time as part of something called monetary policy of the central bank, which they adopt, they decide and act. Like vitamin intake that you have is through a normal course of life, your existence is through food. But now there is deficiency of vitamin in your system, then I artificially inject vitamin. That is the discretionary liquidity. The normal food intake, whatever vitamin you are consuming, hopefully you are consuming from your hostel food, is the autonomous liquidity, or you are wondering whether you consume that at all, you should inform your parents, we are not getting any vitamin. You should get discretionary doses of vitamin sent to us in parcels, so that we can have them. Otherwise, एग्जाम इधर में पढ़ाई खत्म, हेल्थ भी खत्म, दोनों एक साथ खत्म. अच्छा. So, autonomous liquidity and discretionary liquidity, these are kind of two things. This is the normal process of working of the economy. Government needs this money, this is the money, export coming in, imports, etc., creating it. And this discretion is like open market operations, the repo market of the RBI, etc., creates that. The market repo will be part of the autonomous liquidity of the entire system. Okay. Now, if you add this up, whether liquidity has increased or decreased, addition of A and B gives you something called what they call net liquidity. So, this says something which they have in mind, RBI, when it talks about things about liquidity. All right? Okay. Now, the problem is that this is where I have been telling this lady here who is trying to now get into a PhD thesis, I have been trying to tell that this liquidity is a thing which RBI controls it as monetary policy headquarters, head office, head of monetary institutions, with respect to banks only, say CRR, controlling liquidity. With respect to banks, because banks deposits are held as CRR or SLR. But with financial innovations and sophistication of the economy, there are so many non-banks out there. how does RBI control their liquidity? There is no CRR, there is no SLR, but monetary policy should have some significance or relevance for them as well, because you are trying to control the bank's liquidity. Suppose you want to restrict liquidity. You are trying to control it, reduce it through contractionary policy with respect to banks. But the non-banks to maja mein ghum rahe, jo chaande kar rahe. A non-banking sector share in money market is also increasing. This is where RBI has a big headache. This is exactly where the financial system also got into trouble in the Western world. There were not only bank failures and no CRR etc., which they should have had to bail out the banks, it fell on government, but a large number of non-banks started faltering. Housing banks, what are the names? Morgan Stanley was in trouble, then that famous housing market creditor in US, Lehman Brothers ne Aurex, not Citibank. They were all, commercial banks were in trouble, but the non-banks, the housing market they deal with, in what's the name, USMA, this is a non-bank. Non-banks were faltering, and this is one of the problem. The regulatory mechanisms normally in a monetary system is through central bank on the banks, but what's about non-banks? So this is a big problem, all right? Okay. So as this has become very difficult, but what they are doing is that they are trying through the repo market, this we need to find out how much they are trying, to influence the banking sector in particular, but maybe some non-banks are also influenced, I really don't know. What is the name of that housing, housing sector famous, USMA? Okay, I will give you the name. Yeah, funny and yes. What they did was, is essentially they inflated the credit system so much by giving out loans, then the loans didn't return, come back, all right, and then they went into fire sale of properties overnight, whatever value you get, and they couldn't recover the debt. Fannie and something. Fannie, Freddie, kind of names are there, okay. It's very funny, okay. Fannie, Freddie or whatever. Now, this is exactly where they got into trouble, non-banks also, just not banks. Because the non-banks happily giving out loans, thinking a lot of business they're doing, all working on a credit system. What is a credit system? Your base is this much, you're creating credit worth this much. Now, if you mismanage it, the equations, the numbers, you can be in big trouble. And when money which you are expecting to come in, to give out the money to the others and also give the interest on depositors, etc., they didn't. Who is going to help them? Nobody is there to help them. So you declare lockout or whatever, liquidation or something like that, bankruptcy. You declare bankruptcy, अरे bankruptcy तो owner लोग तो घर चलेगा, bankruptcy तो हो गया, बहुत तो बनाए हैं, खाए हैं, लेकिन the entire system which depended upon them got into trouble. All these borrowers, all the depositors, whatever they did, all right, they had public money also with them. Okay. So there was a famous banking committee in India, Narasimham Committee 2, to look into this liquidity management at the end of last century, to recommend banking sector reforms. That's where LAF came, Narasimham Committee 2. There was a Narasimham Committee 1 earlier, I remember, I read it. The Committee 2, essentially they wanted to find out how they can manage short-term funds, liquidity in the system, RBI can manage them, and how they can also provide in a growing economy, where the reforms has already started, end of last century I am talking about. So 1990s decade end, how sufficient liquidity can be made available, because the economy is now growing and companies need cash. more investment. Banks need to provide, the banks just, sorry bhai, hai nahi rupiya, jao ghar jao, which I used to get. I used to go and buy something, sorry, aaj to sugar hai nahi dukaan mein, are, you won't believe me. This were the stories when I was growing up. You went to buy something, sorry, we don't have it. Now you don't get it. The economy has changed so much, unbelievable. You go and try to buy sugar is not available. Right? And the sugar through ration shop, my goodness, you will have the only cup of tea in your life probably with that sugar. You would not attempt a second cup. It was so dirty, full of other things in the sugar, not sugar, whatever. You can be in big trouble. Okay. So, based on Narasimham Committee report on banking reforms, end of last century, in April 1999, this date you should remember, April 1999, they floated something called, April 1999, they floated something called ILAF. ILAF, a program they floated, RBI's program to control liquidity. Okay. What is, it's called Interim Liquidity Adjustment Facility. Interim Liquidity Adjustment Facility. All right. Now, how would they do this liquidity adjustment? And they would try out for a few months, a year or so. And if it works all right, then they would float what we have now for many years now, 10, 12 years, LAF. Okay. If you open RBI site, they will tell you immediately. Repo data open kariye, they will likh denge. These repo transactions are under LAF. Okay. So, interim liquidity adjustment facility, they would operate on a trial basis, like you have developed a prototype, you are going to get a run of the prototype for a few months before you finally announce the product in the market on a commercial sale basis or something, which often happens with many, many products, engineering products. So, this is a financial product, a package. It's essentially a package, a basket of things that RBI introduced or used to control liquidity in the system called ILF, which has few items in it. ILAF has few items in it. So, ILF essentially is talking about the discretionary liquidity to control the total liquidity they would like to have. The net liquidity can be the target liquidity. So, they would try to control it, and this one they have very little control, what they are saying on autonomous liquidity. It is the normal working of the economy. So, normal individual being, I mean, how can you control his body temperature and everything? If there is some garbad, then you try to adjust that. So, to control the discretionary part or to operate the discretionary part, ILAF has a basket of things. First, what they say, or my notes are saying, they would have repos. They would use repos to do that. 2, what will they do? 2, they would use export credit refinance facilities, export credit refinance facilities known as ECRF, export credit refinance facilities. So, they would provide banks, because they just opened up the export market. Remember my notes? Go back to my last course that you credited. Industrial sector, when it opened, there are a few areas where they went for reforms, and the export sector is one of the major sectors they went for reforms. Foreign direct investment, export, etc. So, export credit refinance facilities, banks are giving export credit to exporters, and RBI is going to have a line of export credit for the banks to use the money to refinance export credit to exporters like you and you are exporting. and you use bank money to do your business. If it suddenly stops, your business will get affected, and India is trying to be careful about it. The same thing used to happen with NABARD. RBI used to give funds, NABARD used to use that for agricultural credit. Slowly NABARD became independent. So now banks require extra funds to support the export sector. So RBI is going to give the money to banks, and the banks are going to use that. But there is a system through which it will work. I am going to explain the system later. Export Credit Refinance Facility, ECRF. Then they have collateralized lending facilities. Another thing they had, collateralized lending facilities, called CLF, collateralized lending facilities called CLF, and of course, they would have open market operations. Final, open market operations. OMO, open market operations, OMO. So, is this all? Yes. So, they had a basket of instruments that they would use to control discretionary liquidity, to manage, in order to manage the liquidity in the monetary system, in the economy. Under a scheme called ILF, in April 99, they floated it. This was the Narasimham Committee on Banking Reforms, Narasimham Committee 2 on Banking Reforms. I read Narasimham Committee 1 report many years back. I heard about it. I had references to that. This is the second Narasimham Committee 2 on Banking Reforms, because you would recall from your last course, the course with me, last course with me, there was an Indian economics course I was talking about how in 1991 these structural reforms were initiated by Dr. Manmohan Singh and team, and therefore it changed many things in the Indian economy, and they were very conscious about it. So there was a banking sector reforms committee set up by RBI, I think, or Government of India, I think RBI, which is not uncommon in India. RBI did set up from time to time various working groups and various committees to provide suggestions, advices as to what to be done.